Good morning and welcome to the Maine Community Foundation's 2020 Investment Summary webinar. My name is Jennifer Southard and I'm the Vice President of Donor Services here at the Maine Community Foundation. I will review a few logistics and the agenda for today's webinar and share some general information about the Community Foundation before turning over the program to our two presenters, Peter Rothschild, our Chief Investment Officer, and Jim Geary, our CFO and Director of Investments. Next. We have about 100 people registered for today's webinar. Many of you represent nonprofit organizations who have agency funds with us or donors with advised or scholarship funds. Thank you all for your partnership with the Maine Community Foundation and for taking the time today to better understand our investment approach and performance over the past year. Participant lines are muted, but you can submit questions throughout the webinar using the Q&A button that you should find at the bottom of your screen. I will facilitate Q&A throughout the webinar, and if for some reason your device doesn't have this function, my email, which is on the screen in front of you, is jsouthard@mcf.org, and I will monitor this email during the webinar for questions as well. There are a few times we will pause for questions during the program, but in general, we'll save questions for the end of the webinar. If we haven't answered your questions by the end of the webinar, we are happy to follow up with you separately. We are taping this call and will be sending a recording to all registrants after the webinar in case you would like to review it or share it with your colleagues. We will also post the recorded webinar and materials on our website later this week. Next. As an overview, many of you are friends and family of the Maine Community Foundation, but we have granted out approximately $60 million last year and accomplished many goals. We are nearing our milestone of 500, that's a big number, $500 billion since we opened our doors 38 years ago. Today, we're going to focus on the Foundation's primary investment pool, including our unwavering commitment to a diversified asset allocation and perpetual investment horizon. Next. Our agenda for this hour includes sharing some background information on the Maine Community Foundation, information about our investment committee members and consultants, and a more detailed overview of our primary pool. As previously mentioned, we will allow time for Q&A. Next. The Maine Community Foundation, after 38 years, our mission is relatively unchanged: to work with donors and partners to improve the quality of life for all Maine people. We're based in Ellsworth and have offices in Portland and 4 remote offices: Dover, Foxcroft, Mars Hills, Rockland, and New York City, even prior to COVID. And we're a staff of 39 with close to 500 volunteers to ensure we stay close to all Maine communities. Next. In 2017, we identified 5 strategic goals after holding community conversations around the state, including the Strong Start for Children, access to education, racial equity, thriving older adults, and entrepreneurs and innovators. As we reflect back over the past year, each of these goals have had added importance. 2020 showed us the gaps that exist in our society and challenged us to reimagine how we take care of our children, the role of education in our lives, the racial inequities that exist in all parts of society, the challenge for older adults to thrive in our communities, and the constant need for innovation and support for entrepreneurs to keep our economy strong. Next. Like all of you, we too have been working through COVID-19. We went remote, most of us, in March of 2020. And although we did have 3 staff members who continue to work daily in our Ellsworth office, primarily those involved with accepting checks and getting grants out the door. Other staff have come into both of our offices as needed, obviously taking the necessary health precautions. We started the COVID Emergency Response Fund, and many of you supported this. And through it, we've been able to direct to date over $3 million out to the community. This is the first time our board and organization have ever created an emergency response fund, and we directed $500,000 of our own discretionary dollars to start this. We also received over 400 gifts from donors, including 1.5 million transferred from donor advised funds. We've made over 250 grants to total this $3 million by the end of the year. Thank you for all who have contributed to this fund and work in the nonprofit sector and serve Mainers in need with these resources. We also modified our competitive grant programs and several of our scholarship funds, basically understanding that the need for flexible dollars was more important than ever. We also streamlined our application process and reduced the reporting requirements to meet the needs of nonprofits and reflect the new virtual work reality for most people. We also had an expanded role and activities on racial equity. Because of our ongoing racial equity strategic goal work, we already were supporting organizations and leaders of color and providing racial equity training to white leaders, but that work gained recognition after the murder of George Floyd and Black Lives Matter protest. We received close to $400,000 from over 400 donors to support our racial equity work, and many donor advised funds targeted their grants to organizations that we were able to recommend because of these existing relationships. There was also a very high volume number of gifts and grants as those donors within our organization responded to the needs that they were seeing in the community as well. We processed almost 7,000 grants and scholarship funds totaling $60 million. Both are high water marks for the organization and represent an increase in 750 transactions and almost 20 million more in grants and scholarships than the previous year. We also received over $45 million in total gifts, which is one of our highest totals ever. We're also grateful to an anonymous bequest donor who gave money that for reasons in conversation were fitting to direct to the expansion of our Ellsworth office. And we were able to double the size in our Ellsworth office to 10,000 square feet. The project was completed this past June, 1 month ahead of schedule and on budget, and we hope to be able to celebrate that opening when COVID permits a healthy kickoff. And finally, we had a very active investment committee. Between March and May, the investment committee met over 11 times and made 12 decisions to buy or sell assets during the spring season. And I will now turn the call over to Jim. Next.
Thank you, Jen. Jim Geary here. Thank you for joining us today. I know many of you on the call. I've met with you either in person or telephone or email. We appreciate your attendance today and your continued interest in supporting the Maine Community Foundation. So I'm on the 8th slide in the deck here. This is just an overview of the growth of the assets of the Community Foundation from 2000 to 2020. So it's a 21-year time period. And a couple of bumps along the way that we seem to forget about as time goes by, but 2008 and 2018, we saw a slight decrease in assets. As volatile as the market was in 2020, you don't even see that on this chart. And so in this time period, our assets grow from about 100 million, and we end 2020 with about $660 million in assets. Next slide, please. And as some context for today's call, Jen mentioned some of the different types of funds. This gives you a little bit more information in terms of the size and the role that different funds play within the organization. So donor advised funds represent about 37% of our total assets. That number's been pretty steady over the years at somewhere between 37 and 40%, depending on cycle of grant making and gifts coming in. We've had a very steady increase in nonprofit agency funds, and there are a number of you on the call today. Thank you for your continued support for the foundation. It's a very nice piece of work that we're able to offer nonprofits around the state. And then our other fund types are shown here. Many of you are familiar with our field of interest funds that are competitive in nature for receiving grants, the county fund program, which punches way above its weight class. It shows at 4% of our assets, but it's a really important feature of the Maine Community Foundation. So next slide, please. And then also, again, just to give you some added texture, about 35% of our assets are considered really endowed. People have given us money with income only spending restrictions or instructions to follow our annual spending policy. 45% of our assets are fully spendable. Virtually all of our donor advised funds fall into that category, and there are some other fund types that fit in there as well. And then there's a slice of 21% that allow additional spending with a vote of a nonprofit board. So the agency endowment funds would fall into that category. And there are a handful of designated funds that also have that kind of spending allowance that a donor provided for. So next slide, please. Print's a little small on this one, but this is just to give you a sense of where the primary pool fits into our total assets. And so of our total $660 million in assets, roughly $648 million is invested. The others are receivables that are in trust form or operating reserve type money. So within the invested assets, the primary pool represents about 93% of our assets and almost 92% of our total assets. Next slide. And so I'm going to turn it over to Peter to give a brief overview of the investment committee.
Thanks, Jim, and it's a pleasure to be here again. I think as the former chair of the investment committee before I became your CIO, I am coming up on almost 2 decades of involvement with MCF. It's one of the great passions of my life. We are very brilliantly and extensively supported by an investment committee made up primarily, almost exclusively of investment professionals with diverse backgrounds, as you can see on the screen. Our new chairman as of last spring is Mark Howard, who brings a tremendous amount of perspective and experience in his senior role at BNP Paribas, and he is a extraordinarily enthusiastic and energetic chairman. So we're really blessed to have him. Next. We also had another change. Our long-term relationship with Cambridge Associates and Larry Chang, who was their representative. Larry decided to retire, and we embarked on a very extensive search for a new consultant, considering Cambridge and other firms, and were introduced by one of our committee members to Monticello. They have worked out exceedingly well. Andrew Turbo, who's in Boston, has become a key element in our research and analysis area. All of our investment decisions are reviewed by Monticello, and we draw upon their very extensive experience and database. They are consulting with many foundations, museums, hospitals, and schools throughout the United States, but Andrew focuses on New England, and he is, I think, to date, been a great addition to our team. So with that, I'm going to turn this back over to Jim, and he's going to talk to you about our long-term performance, and I think you will be pleased to hear we're doing pretty well. So Jim.
Thank you, Peter. So I'm going to skip to slide 15, please, which is the performance chart. Thank you. And 2020 turned out to be a really good year for the Maine Community Foundation, as well as many investors. Our primary pool was up about 14.8% last year compared to our benchmark, which was up just under 12. And the universe of kind of a more simple benchmark of 60% global equity and 40% bonds was up about 13.5%. And so on all of those bases, we were well served by our performance last year. I think over the time period that we show here, 20 years, relative to our benchmark, relative to that simple index, and certainly relative to inflation as measured by the Consumer Price Index, we've done extremely well. Our long-term goal, and we'll talk more about inflation and our target later on, but our long-term goal is to earn enough money to cover our spending from our endowed funds, which is 4%, our administrative fee, which is roughly 1%, and our and inflation, which is on average over this time period been just a little bit under 2%. And so we've hit that target over that time period. We're trying to grow the assets in real dollars after spending and inflation. And we've achieved that goal. Sometimes it's easier to do than others, but over this 20-year window, we've done a really good job. So next slide, please. The tailwind we've had has really been driven by large cap US equities. And I have been on the staff almost 19 years on April 15th coming up here. And over that time period, I did a little math and figure if I talk to 2 donors a day on average, either on the phone, now by video call or email, over those 19 years, that would be roughly 10,000 donors that I've spoken with. And people have a lot of thoughts about how we invest and they share their ideas with us. And one of the common themes we hear is your portfolio is complicated, it's a little expensive, and you could do better if you just invested in large cap US equities or dividend generating stocks. So we're going to go through a few slides here that show the long-term power of diversification. So the next slide, please. And so in this slide, you can see how the S&P 500 large cap US equities has done relative to all other equities around the globe, excluding US equities. And so these are really large deviations between US equities versus other non-US equities. And so for a 15-year time period, you're outperforming with US equities by 5%. In the 10-year window, it's 11% or 9%. These are really big margins. And we have a very diversified portfolio, so there's some headwind that we hit with this. Next slide, please. And so for the past 10 years, the primary pool has underperformed a simple index of the S&P and 60% in the S&P 500 and 40% in a bond index fund. And this is a question that we receive on a regular basis. Why don't you just do that? It seems to always work. So if we go to the next slide, we're going to look at 10-year performance time periods for 2 different times. One ending December 31st in 2010, and one ending December 31st in 2020. And so the 10 years ending in 2010, our diversified primary portfolio outperformed that simple index by over 3 percentage points a year on average. And so with the 3.5% yield total return on that simple index, you didn't cover your spending or inflation or any administrative cost of running the portfolio. For the 10-year window ending December 31st, the reverse is true. That simple index did outperform the Maine Community Foundation. And so if we go to the next slide, I've shown each of those annual returns here. So you can see, how choppy it is. You can see those big drawdowns in 2000, 2001, 2002, again in 2008, some flat years that show up there. And it's hard to see the cumulative impact of all of this. If we go to the next slide, I'm showing a 20-year performance for that whole time period. And so over the 20 years, the Community Foundation has earned about 7.9%, and that simple index about 6.7%. And so 1.2% a year on average better than that simple index. And we're not smart enough to know when we want to be fully diversified and when we want to be more targeted to just US equity or some other segment of the market. And so we remain diversified in all conditions all the time. Next slide, please. And so then, kind of in the same line of thinking, I took, this is hypothetical, this is just taking annual returns for the Community Foundation and for that simple index, and said, what if we put in $100,000 on January 1st, 2020, calculate the annual return, how does it accumulate over that time period? And so here you can see the Community Foundation, which is reflected in that green bar, has significantly outperformed on a cumulative basis that whole time period. And if we go to the next slide, I put in another bar in there just to show if you just invested in S&P 500, because it's been on a tear for quite a while now, how would we have done? And so the answer is still not as well as diversification. Global equity allocation, US, non-US, marketable alternatives, these have all worked in our long-term advantage. And so if you look at the 2012 time period here, if you would have been bold enough to have just invested in that large cap S&P 500 index, 3 years into it, you would have been down to $62,000. You would have lost almost 38% of the value of your starting investment. And if you look in 2009, again, just sticking with the S&P 500, 10 years in, you're still at a negative number. You haven't spent any money, you haven't made any grants, you're down about 9% for the first 10 years of your investment. And so the power of that diversification in our portfolio carries us through when different segments of the market are working stronger. And that's what this slide is trying to show. It's why we stay convicted to diversification. It's why we have some asset classes in our portfolio that Peter will talk about shortly that are more complicated, more expensive, but they give us some protection that works in our advantage in the long run. So I'm going to stop there, and I'm going to turn it back over to Peter to talk about diversification and the asset allocation.
Thank you, Jim. Is there a slide missing here of 25? Because I'm on, 25, right. Next, please. All right, so this is a simple bar chart showing what our target allocations are, and the green bar shows you what we are actually doing. And you can see that we're remaining really pretty close to the asset allocation model that we have adopted, shown in red. It is important to note here that the first two groups of bars, listed global equity and venture capital private equity, constitute a little more than 60% of the whole portfolio. So when Jim talks about how the place to be over the last 10 years, for instance, was in US equities, we made a sizable commitment to US equities. We didn't bet the farm on it, but we did make our biggest commitment in that area globally. And in addition, I just would like to point out that real assets down there at 2.3% was the only asset class in the whole portfolio that showed a negative return in 2020. So while we believe in diversification, we also believe that we need to put our largest commitments in those areas that we feel have the best chance of improving our risk-adjusted returns. So if we could have the next slide. As Jim has said, and I think Jennifer began with, our goal overall is a long-term goal of improving risk-adjusted returns as we can, the best risk-adjusted returns we can strategize. And very specifically, as Jim has told you, we believe passionately in the value of diversification, not only because we believe that that's a way of managing risk, but it's also, in fact, provably the way to achieve the best long-term objectives. We have many managers. I think very often I'm asked, as well as Jim's asked, why do you make it so complicated? And as you have heard already, the proof is in the pudding, and it served us really well. If I could have the next slide. Not only do we believe in diversification, but we believe in patience and discipline. And we don't take those terms lightly. Very often there are many studies that show most of the time when you fire a manager or you change your strategy to try and improve things, you in fact make it worse. The manager who has just done well, the asset class that has just done the best is usually, there's a reversion to the mean. And that is a governing principle of our investment strategy. Next. But the strategy and our goal here is more complicated than merely getting the best return. It's also how to manage risk. And we tend to think of risk in two ways: short-term volatility, the ups and downs of different market conditions. But what we're really talking about with risk is the permanent loss of capital. We want to make sure we follow religiously Warren Buffett's rule. Rule number one, don't lose my money. Rule number two, don't forget rule number one. And we believe this. It sounds funny, but it's really the case that we want to make sure that the volatility of the portfolio over the long term, that is the risk of permanently losing capital, is kept to a minimum. Next. There are two other ingredients to this strategy which are part and parcel to the whole way in which we think about investment. We know our goal is not only to earn the most return, risk adjusted, but also to maintain enough liquidity that we can make up to $60 million of grants every year without upsetting the program. So we're limited to the number of illiquid investments, that is ones that have lockups or where you can't get your money out at a moment's notice. We're limited to how many of those types illiquid investments we can have in the portfolio. Not surprisingly, some of the illiquid investments are the best performers. So it's a sort of a balance that has to be found between the amount of liquidity we need in the portfolio and trying to achieve the best risk-adjusted returns. And finally, we have to constantly be aware, as Jim, I think, brilliantly described, we have to be aware that we're in this for the long term. The time horizon for MCF's primary pool is perpetual. And so we need to be cautious about trying to time markets, which we can't do, and effectively, we don't believe anybody can, And we need to keep our eye on the horizon there, not be influenced by short-term volatility or the sense that is commonly the enemy of good investment long-term returns, that is the fear of missing out on something. So I think with that, I'm turning this back over to Jim. Have we had any questions, Jen, that
We have, and there are few that have been asked about some upcoming challenges that I think some of those questions will be addressed later on, but there is one specifically that I think this would be a good time. The question was, is illiquidity of venture cap a problem for you?
If I could respond. Actually, I think that is essentially a problem that we confront in all parts of the portfolio, but it's especially the case there. Other funds that have done very well had huge commitments to private equity and venture capital, and we're limited to the amount that we can have because of our need to maintain liquidity. It has crept up as opportunities have presented themselves, and we've been investing in venture capital modestly for 20 years now. And what's happening is that the very early investments are becoming liquid. So we have the capacity to add modestly to that part of the portfolio, but the liquidity is the key ingredient to limiting our exposure. So are there other questions, Jen, or shall we go back to Jim?
There are, but I think I'll take them in another time, and just a reminder to lean forward into your
Yes, sorry.
audio. Thank you.
So thank you, Peter. So I'm going to go to the next slide here on page 30, and some of what we're going to talk about, I think, will get at the a couple of the questions that have been asked. So this slide here is a slide showing the Maine Community Foundation performance relative to a peer group as measured in the Invest Metrics Endowment and Foundation Fund universe. There's about 120 or so endowments and foundations in this. When we put the slide together, we're still kind of early in the cycle. The number says there are 230, but I overestimated how many were in there. I apologize for that. But here we can see how the Community Foundation is done relative to the average endowment fund. And so in each of the time periods shown here, we've outperformed the average. Not always the case, but I think we look particularly strong over this time period. The longer term numbers tend to always be quite favorable for the Community Foundation. Relative to this universe, over 20 years, we've earned roughly 7.4% a year on average. The average endowment fund in this group has earned about 6.2%. That's 1.2 percentage points better than average. That puts the Community Foundation in the top 4% of that universe of endowment funds. And so if we go to the next slide, this is a similar view, but this is relative to other community foundations. And we did have a question about other community foundations. And so this is how Maine has done relative to other community foundations. And there are roughly 650, 700 community foundations around the United States. And the Maine Community Foundation, in the last data survey that I saw for 2019, I don't think the 2020 data is out yet, we were the 39th largest community foundation in the United States. So we compare very favorably. We are considered a large community foundation, and we compare favorably with that universe in asset size. But again, also relative to performance over that 20-year time period, these numbers are pretty close between those two universes. The Community Foundation has returned 7.4% relative to the average community foundation of 6.3%. And in this universe, that puts us in the top 3% of that universe. Peter mentioned, we're perpetual investors. We're at this forever. Long-term makes a big difference to us. Our funds should be here either forever or for a very long time. And we're really measuring ourselves against these long-term numbers. And so to be in the top 3%, top 4% of those peer universes is something that gives us a lot of comfort, a lot of confidence that we're making the right decisions at the right times. We have the right asset allocation, and we continue to be confident that those are in fact true and remain true. So if we could go to the next slide, I'm going to ask Peter to talk a little bit about the volatility in the portfolio. This goes back to that risk conversation that Peter was referring to earlier.
Thanks, Jim. Actually, it may be a little difficult to understand this chart, but the Maine Community Foundation is shown in the red and the benchmark in blue, and all it's talking about here is how bumpy the ride is over 10 years. And if you look at the extreme right-hand side of this chart, you see that the Community Foundation's bumpiness, or ups and downs, drawdowns and outperformances, were considerably less than the benchmark. And that is a point of pride. It's a little nerdy, I agree, but it shows you that our diversification, our diversified approach has achieved a dampening of the bumpiness, a dampening. We've had a smoother ride, and as Jim just said, and achieved outsized returns. So that is really the goal. When we talk about risk-adjusted returns, we're talking about, can we manage volatility and still show outsized returns? And this really speaks to that point. So Jim, do you want to pick up again?
I will. Thank you, Peter. And the one item I would just point out on this slide that we're on right now, and this question does come up regularly. It's back to that, why is your portfolio so complicated? Why is it so expensive? And the third set of data over around the marketable alternatives, some of these are commonly referred to as hedge funds. And so in this space, over this 10-year time period, the hedge funds, marketable alternatives have returned about 6.1%. It's less than the equity return at 10.3%. But the volatility at 5.6% a year relative to the volatility in the equity portfolio at over 15 is roughly a third of the volatility. That is substantial. That smooths out those returns. That takes the bumpiness out of the road. And that does make a difference for us because we have money constantly flowing in and out of the portfolio in the form of gifts in and grants out. And so when we make money and when we lose money, it has a profound impact on money coming in and out of the portfolio. So the smoother the ride it is, the more fair it is, and the more comfortable it is for the underlying funds and the donors in the portfolio. If we could go to the next slide on number 33, we referenced this a little bit earlier. Our long-term goal is to earn enough money to cover the grant spending, the administrative fee, which on average is about 1%, the rate of inflation, which over this time period has been 2 to slightly under. And so our required return is shown here, and I put in our actual returns over those time periods. In each of these 5, 10, 15, 20-year windows of time, we've hit our goal. That is not always the case. Even with those really outstanding long-term investment returns that we have relative to the peers out there, sometimes we fall short. But right now we're hitting all of the marks that we want to for those longer-term time periods. And this is our goal. This is the responsibility that we have to our donors who've given us money, who want that money to be here and provide real value to the organizations that they are granting money to. And we take that fiduciary responsibility very seriously. And we're very happy that we're hitting those goals for these long periods of time. You can go to the next slide. There were some questions in the Q&A that talked about how frequently we reallocate the portfolio, how frequently do we look at the allocation. So the investment committee, Peter Rothschild, Jim Geary, the consulting firm Monticello, ordinarily we meet once a quarter. When the markets dropped sharply in early March of 2020, we started meeting weekly, at times more than once a week. We were making active decisions to rebalance the portfolio in that time period. We've done this at other points in time in the past. Peter and I have been around here for a while. We have investment committee members who have been here since 1997, 1998. And so we did it in 2000, 2001, 2002 during the tech bubble burst. We did it again in 2007, 2008 during the subprime lending bubble burst. And then we did it again in March of this year with the COVID disruption. And so in this time period, we increased our equity allocation. Those values dropped sharply. We put money back into equity in March, April, early May of 2020. We added to some managers and we took away from some other managers that were not as promising going forward. And so in aggregate, it was an $8 million total increase allocation to equity, but we reconfigured the underlying portfolio. Every one of these decisions worked in our favor, some of them substantially. We had investments that we made in a mid-cap growth manager that we put $5 million into that manager in March and early April. That investment grew to over $10 million, over 100% return by the end of the calendar year. We had money that we put into the passive indexes at the S&P and the ACWI index. Those were up 40, 50% over this time period. And so we look at the allocation every quarter, we take action as needed. Frequently, we have cash flow in the portfolio to reallocate. You could go to the next slide. This is just more kind of tinkering that we did during the time period. We reduced our marketable alternative allocation by $12 million. Most of it was from one manager that was in distressed debt, and we were less optimistic about that going forward. And so we moved that money out of marketable alternatives, and some of that went into the equity portfolio. It was an unusual year. In our 38-year time period, we've had very rarely a negative cash flow in the portfolio, but we had about $16 million more flow out of the portfolio than we had come in. And I would say thank you to our donors who were very generous in their grant making, primarily for COVID-related issues. And they stepped up and they granted out more money than they gave us. And I think that was the right thing to do. We're happy that that happened. Not at all troubled by the fact that we had a little negative cash flow in the portfolio. I'll go to the next slide, and I'm going to ask Peter, and again, this was a question that's come up. What are we thinking about going forward? So Peter, if you could step in here.
Thank you, Jim. You know, I have a standard question I ask every manager that we ever consider hiring or seems interesting. What are the best opportunities that you see going forward, and what keeps you up at night? What do you worry about? And I think across the board, that is the underlying principle that we follow in thinking about the future generally. And as you saw in those moves that we made last spring in March, April, and May that worked out so well, these were really on the basis of, given the valuations we saw in the over 30% drawdown in the S&P in the middle of March, what opportunities did that suggest? But there's a chastening aspect to that kind of analysis. And I think if you look down this chart, you see that the S&P was up 31% in 19 and 18.4% in 2020. This is roughly 2.5 or 3 times what the average return on the S&P has been since 1926 when it was founded. And it doesn't mean that you have to be a confirmed pessimist or a naysayer. It's hard to imagine a world in which those kinds of returns will be achievable in the future. So I would say generally in 2021 and beyond, I think have been blessed with great returns over the last few years. And I think it is unlikely we will see returns comparable to 2020 or 2019 in successive years going forward. It's not because I have a crystal ball or because I know more than anybody else, but I would say if you look at equity stock valuations today and interest rates that are near zero, the federal government and governments throughout the world have really opened their checkbooks like there was no tomorrow, run up enormous debt, and that has been a great tailwind for global equities. And, you know, we are seeing in some countries negative interest rates, but in the United States, we are near rock bottom on interest rates. So looking forward, I think we are going to be constantly looking for new opportunities. What areas of capital markets will prosper if things are not as robust in the large cap equity area? Jim mentioned distressed debt. We have a couple of managers who are banking on the fact that easy, cheap money won't be around forever and that companies will be stressed and need to borrow. And in fact, some of those investments, even in 2020, worked out exceedingly well. We are constantly, as I say, searching for new opportunities that will add to the diversity of our whole program, improving our goal, our overarching goal, which is how do we get the best risk-adjusted returns we can, given the other constraints we face. So with that, I will turn it back over to Jim.
Thank you, Peter. Peter did hit on a couple of the questions that have come in, and I'm going to hit on a couple of more here in a moment. And someone did ask about, you know, the rapid increase in the U.S. deficit. Are we concerned about that? Peter touched on that. We have been concerned about that for a number of years now. In our fixed income allocation, which is by benchmark a bond allocation, we've been carrying half to slightly more than half of that 15% target actually in cash in a money market account, FDIC insured related type of products. And if interest rates do go up, bond values we know will go down. And so we've been concerned about that rise in interest rates. It seems to be cropping up again right now. They unless they do go negative, unless interest rates go negative, we don't have anywhere to go but up. We've seen a pretty decent uptick in the 10-year Treasury bond so far this year. I think the yield has doubled in the first 8 weeks or so of the year. And so that is a concern for us. It is part of the reason why the portfolio is as diversified as it is. It is part of the reason why we invest in marketable alternative assets, which, although not bonds, are at some level helpful in having a lower correlation to bonds and a lower correlation to equity. They behave differently in different markets. And so all of that factors into our thinking, and certainly the increase in the US deficit increases the need, in our view, of having that kind of diversification.
I'd just like to jump in there, Jim, to just stress that the term marketable alternatives sometimes refers to traditional hedge funds. There's relatively little of long short equity funds in that portfolio. They are highly diversified into areas that are even somewhat complicated to explain. But the goal there, as I think Jim mentioned in previous slides, is to limit the volatility of the portfolio without impacting its return possibilities. And that has been the governing philosophy behind those marketable alternatives. So I think hedge funds tend to cover a very broad range of diversity of strategies. And some of them, the ones in the news that you've heard about recently, are highly levered. They use a lot of borrowed money. And we just did an analysis, and in fact, all those marketable alternatives, there is very little leverage being applied.
Thank you, Peter. So there are a couple more questions that are germane to things that we've already covered. And one of them relates to, with all the changes that we made in 2020, was Monticello part of those conversations as the consultant? And absolutely. The amount of time that Peter and I, and earlier in the year, Liz Hiltman was the chair of the committee until the middle of June. And then after Mark Howard took over in June, the four of us in one combination spent a lot of time with Andrew at Monticello. At times, I'm sure we wore out our welcome. And I was talking to Andrew multiple times a day, and with Peter on the calls or by email. And we were very careful to, they were at the table in all of those conversations. At the end of the day, the investment committee really does own the strategy, own the allocation, they own the managers. We would not look to Monticello at this point to say, you made a bad manager pick. Those are our decisions. Peter puts a lot of work into hunting those managers down. We use Monticello and previously Cambridge Associates to vet those managers to make sure they meet the standards from a due diligence that we want to have. And they're part of the conversation every step of the way. So I'd like to go to the next slide, which addresses a few of the questions that have come in about ESG investing. And so the title of this slide is Sustainable Investing. And so this is a growing conversation, not just for the Community Foundation, but all endowments and foundations around the globe. And our investment managers hear the message from their underlying investors. And so we've established a subgroup of the Community Foundation Investment Committee that's comprised of committee members, Peter and me. Mark Howard, the chair of the committee, is also an ex officio member of it. But we're putting together our thoughts, defining what does sustainable investing mean. And so we're working towards that subgroup making recommendations to the investment committee and the board. Our long-term objective remains the same. We want to have credible investment returns that meet our objectives of real return above inflation and spending. We have that responsibility to the people who have given us the money. And we want to find a way to implement some type of a robust, sustainable investing strategy that doesn't compromise those long-term returns and criteria that we have. And so that work is going on during 2021 right now as we speak. And we don't have a solution that we're putting on the table at this point. It's still in the development stage. we are carefully considering this and how to implement it for the portfolio. And I see one other question here that says, do you have an allocation to gold? Likely some of our investment managers do in fact own gold, but it's not a material allocation. And then there's another question, do you have investments in farmland and timber? We do. They're actually in the wind down process. In the asset allocation that Peter went through, you saw the real asset bucket that is comprised of two different major classes. One is real estate, one is natural resources. The natural resource allocation included investments with an investment manager, Park Street Capital, who's winding down their funds. And some of those investments were pretty substantial in farmland. But that is a piece of our portfolio that we are winding down. And so at least for now, we don't have a lot of allocation towards farmland. And a couple of questions that have come up on investment cost and fees. So these are two different buckets. So the administrative fee that the community foundation assesses all of the assets in the portfolio depend on the fund size and the fund type. And so our funds that cause more work for us, for example, a scholarship fund, where there are individual student applications, there are renewable scholarships, following an individual student to whatever college they're attending. They frequently change schools. That's our most expensive type of fund. And so that fund is assessed a fee of 1.5% on the first $1 million, and it tiers down from there. The other end of the spectrum, the designated fund or an agency endowment fund, are simpler for us to administer. Those funds have our lowest fee of 0.85% on an annual basis, and they tier down over $1 million, and they tier down very aggressively over $3 million. On the investment cost side, in terms of the overall cost of administering the portfolio, the manager fees, custodial cost, Cambridge Associates, that cost for years has run right around 1% of the total portfolio. All of the performance numbers that we review in the portfolio, in every single slide where we talk about investment performance, it is always net of the investment cost, 100% of all the investment cost, whatever it might happen to be. And so our investment returns relative to our benchmark, relative to a peer group, are net of all of the investment cost. They're before the administrative fee because that depends on the fund size and fund type. And so in our long-term investment goal, our goal is to cover that administrative fee cost, whatever it might happen to be. And so in simple terms, our investment cost is roughly 1% of the portfolio, always netted out of the returns that you see. And the administrative cost varies. And for a larger fund, we have donor advised funds that tier down, and they're in the 0.3% or so. But the average donor advised fund would pay a fee on the first $1 million of 1.25%. And so there's one last question here. You mentioned large deficits that our government and others are incurring just now. Can you expand on what the strategy this red ink suggests? So Peter, I'm going to ask you if you're willing to take that one. I would appreciate it.
Well, objectively, a spike in interest rates usually is accompanied by a spike in inflation. One of the, I think, great risks to the global economy right now is that efforts to increase inflation modestly to 2%, I think, is the target, or 2.5%, that sometimes these go awry and we end up with runaway inflation. And so in order to protect against inflation, which is often accompanying higher interest rates, if not always, is traditionally real assets. So that's been the part of the portfolio that we're have lightened on. We're winding down, but I would think going forward, we would probably look to see how to maybe increase our real asset allocation or find new opportunities in real assets. It's a hard to do. Equity prices often are also inflation hedges, but as I said, I don't think we feel very optimistic about great returns or comparable returns in the next 5 years as we've seen in the last 5. So I would say that we are in the process of researching opportunities, particularly in the areas that may provide some hedge against higher inflation. To be specific about what that might be, whether it's real estate or some commodities, or as one of the previous questioners asked, farmland or raw land. These are areas that we have been less aggressive in researching in the past and probably will become more aggressive in the future. So I hope that in some ways answers the question. We don't have a crystal ball, but we do know when there is, as you point out, a great disparity between the mean amount of international debt and where we are right now, and where we seem to still be going, and that is going to present opportunities in the future.
So Peter, thank you. Helen, if you can advance to what is basically the last slide. I know that we're at time. We just wanted you to be aware, all of you who are fund holders should have received in the mailing of your most recent fund statement the news that Steve is retiring this summer. So the board will be putting together a search committee to look for the next CEO. And we'd like to thank Peter Rothschild for his years of service. He will be retiring as Chief Investment Officer this June, and Jim will be stepping into those responsibilities. And starting Monday, we have a new CFO, Michelle Camarco, who will be replacing Jim as CFO. And we're also looking to add some support for ever-growing investment accounting requirements, so that the information and performance you've seen over the years will continue and be sustained well into the future. And so with the next slide, really, it seems like there's been a lot of questions that we've been able to answer. But since we are at time, we're happy to follow up with any of you after the program for any unanswered questions, particularly if they're investment related. Jim will be the better person to reach out to, but there are questions related to those of you who are fund holders, particularly donor advisors, that I'm happy to respond to. And with the final slide, we really would appreciate your feedback. My contact information is there, phone, email, and mailing. We really appreciate you taking time with us today to learn more about our 2020 investment performance. Thank you.
Thanks, Jen. Thanks for everyone for joining.
And thank you, Jen. You did a great job.